Welcome, everyone. Good afternoon. Good afternoon, everybody. Thanks for joining us. I want to go ahead and get us started with the introduction so that we can get right down to the great information that Shahar has brought for us today. So I'd like to say good afternoon and welcome to the second session of HUECU's Personal Finance Summit. We are so grateful that you all could be with us today and hopefully in the days to come as well. My name is Sarah Scruggs and I am the Community Engagement Specialist at the Harvard Employees Credit Union. I also have Migdalia Gomez on with me, HUECU's Community Engagement Manager and the moderator for our Q&A today. Harvard University Employees Credit Union is proud to be Harvard University's not-for-profit financial institution, serving our community with customized products, services, and financial education, such as our Personal Finance Summit. Our sessions are being recorded and will be shared via email at the end of the week. Please feel free to share these recordings with those in your circles who you believe could benefit from them. Throughout today's presentation, please do not hesitate to type in the Q&A box any questions you might have for our presenter. We expect to have a few minutes for questions toward the end of the session. We will also have a survey that will be shared in the chat towards the end of the session as well. Please let us know your thoughts on the session so we can continue making these programs a success. If you do fill out the survey, there will be an opportunity to be entered into an HUECU swag box giveaway. For today's session on understanding investing, we have Shahar Ziv joining us. Shahar is a graduate of Cornell and Harvard Business School and currently works at PayPal as the Senior Director of Strategic Initiatives. He is a contributing writer for Forbes and serves on the board of directors of the Harvard University Employees Credit Union. He is the co-founder of the Harvard Personal Financial Management Winter Session course at Harvard University, and he's also thrilled to have the opportunity to be involved with our Personal Finance Summit this year as well. Shahar, take it away.
Thank you so much, Sarah. And hi, everyone. Thank you so much for taking time out of your day to join us for the summit. I'm really excited to be here today to share some tips and tricks around building wealth, which really I think of as an introduction to investing. So I'm going to go through and try to provide you with some practical kind of guidance and try to demystify investing a little bit. And as Sarah mentioned, please don't hesitate to use the question and answer feature to ask questions, and we'll make sure to leave time at the end. So before I kind of start, one of the key questions I think whenever you're getting financial advice is, why should you listen to the person who's giving you the advice? So for me, just so you know, I am really, really passionate about personal finance. As Sarah mentioned, I co-founded the Personal Financial Management program that's taught at Harvard about 10 years ago. Crazy to me to think that it's been 10 years, and have been coming back every January to teach that. And I've since expanded, and I do a lot of work with students and employees at different universities, whether they're undergrads, graduates, and have worked with a lot of different employers. And I love both kind of speaking and teaching on this. I love writing about it. And it's just something I'm very, very passionate about and love to kind of pass along to others. But the most important thing on this slide to me is the bottom point. And really, the first piece of advice that I would give any of you is, when you're getting financial advice, especially when it comes to investing advice, you need to talk to someone who is objective. And ideally, this is someone who isn't affiliated with any type of company that's trying to sell you investments, someone whose compensation may not be tied to any recommendations that you take on. Essentially, you want someone who doesn't have conflicts of interest and who's putting your interests above anything else. And so for me, I like to stress, I sit on the board, but I'm not affiliated in kind of any other way. I'm not going to recommend any products or services that I receive compensation for. I can't, and I don't want to manage your investments. I can't do your taxes. I'm not here to sell you anything. My motivation here is to kind of demystify investing and just help you kind of take the first step on kind of that journey. And I think it's a really, really important point to stress. There are a lot of great people out there who have your best interests at heart. Unfortunately, there's also folks who have conflicts of interest and may not have your best interests at heart. And it's really important to kind of ask that question and take that step back and say, should I be listening and should I be trusting the advice that I'm getting from this person? So to set expectations, Some of you may know person on the left or person on the right. On the left, of course, is Warren Buffett, the famed investor and founder of Berkshire Hathaway. On the right is Melody Hobson. She's the chairwoman of Ariel Investments, one of the most successful investment management companies out there. In the 60 minutes we have today, I can't turn you into either of them, unfortunately. Really what I want to do is help you start to build a little bit of a toolkit around investing. We'll talk about some facts, but really what I want to focus in on is some insights and strategies that'll set you up for hopefully more education and kind of more work around investing. Really, all we're able to do today is scratch the surface, but hopefully that'll be enough to at least set you on your way. So I want to start by giving you what my opinion is the secret to investing. So for any of you back in school, you always work up to the test and the answers. I like to start with it. And this is going to be something that's probably a bit counterintuitive, but the secret to investing, 2 words, be average. Now, for many of you, probably is very counterintuitive. If anything, your success during school, in the workplace, in life has been about being anything but average. Your parents probably never told you, aim for mediocrity. If anything, it was always aim to be the best. But what I would argue is that when it comes to investing, being average is the way to go. And the paradox is that by being average or aiming for average, you often will end up above average. So let me prove that to you. Back a while ago, Warren Buffett, who we just covered, put out a bet. Now, Warren Buffett is the biggest proponent of average investing. And what do I mean by average? We'll go into a little bit more detail as we go through, but what he means by average is basically looking at different financial instruments, including mutual funds, that all they attempt to do is to track the market. They track, all the different kind of indices like the S&P 500, the NASDAQ, etc. These are very plain vanilla investing instruments. They tend not to cost a lot of money. And all they try to do, they don't try to beat any of these indices. All they try to do is match them. And what Warren Buffett said is, I am so confident in my advocacy for being average that I will put my money where my mouth is, and I will bet anybody $1 million that my average investments will beat whatever other financial instruments this other person or team wants to invest in. One hedge fund, Protege Partners, took him up on that bet. They each put up $1 million. At the end of the day, this is a win-win because they agreed that whoever loses would donate to the charity of the winner. So at the end of the day, all the money was going towards a good cause. But obviously, with my kind of leading about being average, you can even imagine who won. And so what you see here are the results that kind of happened in 2017 at the end of this 10-year bet. And you can see that all the way on the right, Warren Buffett's average investment, and all he did is he picked one mutual fund, and we'll talk about that in a little bit, that all it did was track the S&P 500, which is kind of just one of the markets that has a lot of different kind of companies within it. And you can see that his returns were 125%. Now, Protege actually invested in 5 different hedge funds and other kind of funds. Their average return was only 36%. So, a little bit better than a quarter of Warren Buffett's return. And you can see that some of their funds returned a really good amount, 87%. Others, not so much, 2.8%. But at the end of the day, by aiming for average and using average funds, the S&P 500, you end up being above average. So keep that in the back of your mind. And I know in today's world with, cryptocurrency, Bitcoin, kind of GameStop, Reddit, all of these different things come up, you see kind of people swinging for the fences. And most of the time you only hear about the very few who actually succeeded. What you don't hear about is a lot of people who lost money. And what this is meant to show you, and I'll show you some other examples, is slow and methodical, and frankly, a little bit boring, ends up winning the race in most cases. So let's start to dive in a little bit. Why is investing so critical? One of the reasons is that investing is one of the only ways of actually staying ahead of inflation and really generating returns on money that you put away. Right now, the average savings rate pretty low. Overall, interest rates are pretty low, and even the best of financial institutions are probably not offering anything close to even 1%. What you see in the top right is the average savings rate, basically over the past, past year or two, which is less than 0.1%. On the bottom are bonds, which we'll talk about in a minute. Bonds are basically debt that the government or a company issues. It's almost like an IOU. And you can see that even when you adjust for inflation, they've only returned about 1.1% over the past 100 years up to 2014. And if you look at the inflation rate in 2019 and even starting to creep into 2020 and 2021, it usually hovers a little bit above 1%, between 1, 2, and 3%. And the inflation rate is critical because if you have $100 and you put that under your mattress, in a year, you'll have $100. That's it. You won't have any more or any less. But inflation basically means that $100 is going to be able to buy fewer goods and services. So if you were buying a gallon of milk last year, and let's say it cost $1, and inflation was, let's say, 5%, this year, that same gallon of milk is going to cost $1.05. And so if your money is under the mattress, or in this case, even in a savings account or in bonds, you may not even be making enough to reach or kind of exceed the inflation rate. The only kind of investment vehicle that over the long run has been able to really, really substantially beat inflation is looking at things like stocks and stock-based mutual funds. And you can see in the bottom right how much they have actually trounced inflation and how much they actually even beat bonds or money in a savings account, returning about 8.3%. So to put it another way, if you had invested $1,000 back in 1915 and you let the money sit there and grow, if you had invested that $1,000 in bonds, you would have a little under $3,000 in 2014. If you had invested that money in stocks, you would have orders of magnitude or multiples more than that, about $2.3 million. So over the long run, stocks are one of the best ways of really generating wealth and having your money grow exponentially. So I like to start with that as kind of just an initial view on the importance of investing and why it helps you actually generate wealth and actually keep up with inflation. Now, let me just ask a question. You should feel free to type in answers in the Q&A. Imagine one day you're walking down the street and you pick up a penny. This is not an ordinary penny, it's a magical penny. The reason it's magical is because it doubles in value every single day. So you pick it up on day one and you only have 1 penny. On day 2, you have 2 cents, then 4 cents, 8 cents, 16 cents, 32 cents, etc. Any guesses how much money you'll have on day 31? Feel free to type in answers into the Q&A. It's anonymous, so no worry about getting it wrong. Any thoughts on how much money you'd have? One person writes 4.2 million. Great guess. Any others? Somebody else said $200. That's a pretty big range here. Any others? 1 million. $100. Ooh. All right. All great guesses. Let me say that even the person who wrote 4.2 million is undershooting it. 1 penny on day 31, or after 31 days, would grow to be $10.7 million. That's pretty impressive. Now, let me ask you this as a second exercise, and we'll do 2 more little scenarios here. What if you missed getting that penny on the first day and you didn't find it, or maybe you didn't leave your house, you were busy watching Netflix? Let's say you only found that penny on day 2. Any guesses as to how much money you would have at the end of that initial 31-day time period? Yeah, so somebody nailed it. They put 5.3 million. You're right. Exactly that, which is almost half because you're missing the last day of doubling. Now here's one more exercise for you. What if you didn't pick up the penny until day 10? How much money would you have at the end of the initial 31-day time period if you only picked up the penny on day 10? Some of you may be busy crunching on your calculator. If anybody opened up Excel, that'd be great. I see $5,200, $2,600, all close. You would have about $20,000. Really, really close on these guesses. So thank you for participating. Always helps here. this is, to me, a really crucial point, and you see it kind of called out there in terms of the time value of money. Essentially, this is showing you the power of investing and basically the power of exponential growth. And what happens when you invest and put money away is not only are you making money for the next year, but then money that you made one year starts to actually compound on itself, and you make money not only on the initial investment, but on any of the gains from the next year. And the reason this is called the time value of money is because it does lead to really big returns. Here I'm showing it in a very hyperbolic way where 1 penny grows to be $10.7 million. But what you notice, I'd say a couple of things. One is, if anybody promises to double your money in a day, or even if they promise to double your money every single year, you should be very highly skeptical. If you go back to what I showed before, the average return in the long run for stocks is about 8%. So anybody that's promising 100% return in a year, you should be very wary of that and probably consider stepping back. But what you can see here is how important it is to actually start to invest early. And the reason is that it gives you more time for your money to grow. You can see here how when we invested on day one, you actually got to $10.7 million. And when you skipped one day, you got to half of that, only $5.3 million. So even though your money is doubling, in this case, every single day, the absolute dollar amount that you're getting changes, right? Let's say you're going from day 5 to day 6. Your money's doubling, but you're only making 16 cents. Even from day 9 to 10, your money's doubling, but you're only making $2.56. But when you get to these last few days, the absolute amount of money that you're getting every time the money doubles is huge. You're getting 2.6 million to 5.3 million. You're going from 5.3, you're getting another 5 million. And so what you can see is that by starting one day earlier, on day one instead of day 2, you double your money and end up with $5 million more. And it's these last doublings that really matter. But in order to get to those, the only way to get to those is by starting early. And the other point I would make is that when you start later, and even a delay of 10 days, or think about this in terms of maybe saving for something long-term like retirement, if you delay, it's not the end of the world, but it does mean that you're going to have to put in a lot more to catch up, because you can see here how starting on day 10 only gets you to $20,000 at the end, which is a far cry from 5 million or 10 million. So this notion of the time value of money is critical when you're thinking about investing, because the earlier you're able to start, the more time you're giving yourself for your money to grow. And that really is one of the best ways of really starting to generate returns. To give another kind of example, which some of you may have heard about, I, for a long time, lived in New York. Some of you may have heard about this myth, which was that in the 1600s, Peter Minuit came across, and he actually convinced the Wappinger Indians to sell him the island of Manhattan for $24. And usually the story is told in, oh my God, how was he able to get this for only $24? But if you apply some of these principles of the time value of money, and let's assume that there was a stock market back in the 1600s, you'll see that the deal may not have been as bad as initially thought. If you took the land value of the, Manhattan today, land value is worth about $1.4 trillion. But if you had taken that $24 and you had invested it in a stock market that may or may not have existed in the 1600s, and you were able to get 7% interest every single year, you would have about $8 trillion today, a lot more than the 1.4 trillion. This is all illustrating the same concept of how your money can grow exponentially, and really the power of compound interest. So, I always just start with a key takeaway number one, which is saving early and saving consistently are really, really important. Now, some of you may be in school, some of you may be early tenure employees, some of you may be in your middle or late careers. There's never a point where you can say, today is a good day to start. Even if you're, in your 40s and you say, you know what, I haven't had a chance to save up until now because I was busy paying back student loans. I was busy, saving for my children's education, busy paying for rent and other things. Never too early to start. So the earlier, the better, but today is the best day to start for everyone essentially going forward. So let's get into a little bit more of the meat of investing. And I want to cover a couple of different themes. I want to talk about saving versus investing and how I differentiate between the two. thinking about your time horizon and how much risk you should be taking on with investing, how you can use that to align with goals. And we'll touch a little bit on whether you should be investing alone or whether you should be getting help. And if you get help, what should you be thinking about and where could you possibly go? So before you really start to invest, I think that putting aside money for different types of savings or kind of other kind of needs is really, really important. So one, I would say you really want to make sure that you're building up an emergency fund, which I think of as a stuff happens fund. You want money that if you happen to lose your job for a couple months or more, if you have significant unexpected medical expenses, if you own a home or apartment and the boiler bursts and you have to replace it, you own a car and the car is totaled and insurance won't cover it. You want money that you're able to kind of use to pay for those unexpected expenses without taking out different loans. And so before you really start about thinking about investing, especially in the stock market, I think you want to make sure that you have an emergency fund built up. Usual rule of thumb is to have between 3 and 6 months of expenses on hand. So if you are building a budget and you know how much you need in a given month to pay for housing, food, transportation, insurance, healthcare, et cetera, you should be aiming and aspiring to build an emergency fund that has between 3 to 6 months of those expenses. So if you do have a shock to your system, you have a couple months saved up that can cushion it. Number two is paying off all of your high interest debt. And I focus here specifically on credit cards. If you think about the rate of return that we talked about, let me just go back here. The rate of return on average for stocks, which are the highest paying amount, was about 8% on average over the long run. I don't know about you, some of you may know, but do you know the interest rate on your credit cards? I would venture to say that it's probably double digits and probably even higher than low double digits, going up to 15 or even 24%. So if you could be putting $100 away and earning 8%, or if you don't pay off your credit card debt, you are essentially having to pay 24%. That's quite a kind of a difference, and you're better off in that case actually paying off your high interest debt. The other piece that's a little bit of a bridge between saving and investing is around maximizing contributions to retirement plans. Putting money away for retirement is definitely a subcategory within investing, but I think of it a little bit differently here. And I think about, especially before you invest for other goals, making sure that you are putting money away for retirement is crucial. And this is especially important if your employer happens to offer a match on retirement contributions. This isn't for everyone. It's only about between 30 and 50% of employers that do this. But if you are fortunate enough to work at an employer that says, if you put away 4% of your salary, we'll match dollar for dollar, that is an amazing privilege and one that you should be taking advantage of. If you're let's say an employer that matches dollar for dollar, and you put away $4,000 and the employer matches $4,000, you're getting a rate of return of 100% right away. And that's going to beat anything else that's out there. So I always like to just point out that before you really start thinking about investing, you really want to think about some of these other aspects of saving. One point of clarification on the emergency fund, there was a question that came in around whether this should be in cash, in a retirement account, investment fund, or a credit card. My strong recommendation for the emergency fund is that you keep it in a very liquid account. And what I mean by that is it should be in a checking account, a savings account, or a high yield kind of online savings account. The reason I suggest something that's very liquid and is twofold. One is money in a checking account is pretty stable. It's not volatile based on outside conditions. And so money that you're going to need right away or potentially in the very near term, you don't want that to be very volatile. So I wouldn't necessarily recommend putting an emergency fund in something like an investment fund, because if the stock market happens to tank and that happens to coincide with when you lose your job, that money is going to be worth much less. So I highly recommend putting emergency funds in a checking or a savings account. And ideally, it's actually creating a separate checking or savings account that you don't think about or touch on a daily basis. You want that money out of sight, out of mind. You don't want to be tempted to kind of, tap into it if, you had a bad day and you're trying to, let's say order food or, go on kind of some shopping therapy. You want that money very much out of sight and out of mind. Okay. So I want to just quickly go over, and this presentation will be made available, so I'm not going to go into this in too much detail, but there are some different terms that I've already used a little bit, and I think I'll use a little bit later, that I want to make sure everyone is familiar with. So checking your savings account, which I just covered, the money that you put in is essentially protected from loss. And a lot of times, if you earn interest, even if it's a minor amount, you are kind of getting guaranteed returns on the money that you put in. The money that's guaranteed is usually up to about $250,000 per account, which is what kind of the FDIC insures it for. And examples of these would be kind of the Harvard University Employees Credit Union checking or savings account, and other kind of financial institutions accounts, online accounts, etc. Money market accounts, very different kinds. These are slightly different from checking or savings accounts. You may have heard of CDs or certificates of deposit. Other types of accounts where basically money is it's very similar to what's in a checking account. You basically have short-term government loans. The principal is almost as protected as in a checking or savings account, maybe a little bit more risk. Bonds are basically what I talked about as IOUs from a company or government. And basically, when a company or government issues bonds, you are almost making a loan to that company or the government, and they're promising to return you, the principal or the amount that you loaned, plus a little bit, basically the rate of return, either every month or at the end of when that bond or loan is due. So some examples of these, you may hear about treasury bonds, or you may be able to buy a bond from a company like IBM. They also issue bonds. The other kind of key term here is around stocks, or you may hear things about equities. So unlike bonds, which are an IOU, essentially they're debt that a company or government issues, if a company issues stock, they're basically issuing and allowing people to buy ownership in the company. And so if you own a share of stock of Apple, you actually have a sliver, a very, very small sliver, but you own a piece of Apple as a company, and you can actually go and vote using your kind of shares. The way people make money on stocks is if the price of shares goes up, and or if some companies give out dividends, or which are basically a recurring payment every quarter or year, and you can be making money off of that. Another term which I'll use very, very often is mutual funds. Mutual funds are basically a collection of stocks or a collection of bonds. Basically, what mutual funds are meant to do are to pool a lot of these stocks or bonds together to help reduce risk. And instead of saying, oh, you have to go and buy shares of Apple, Netflix, Tesla, et cetera on its own, you can buy a mutual fund that somebody else has already put together that already houses a collection of different stocks or different bonds. An example of this is my favorite kind of investment management company is Vanguard. They have a mutual fund that's called the Vanguard Total Stock Market Index Fund. Similar, Warren Buffett would probably approve of this one. It's an index fund, which means it's very, very average. And this is just an example of kind of a mutual fund that you may be able to find on the market. So with that, let's put these into play a little bit. The reason I talk about these is these different investment choices have different levels of risk associated with them. So a checking or savings account has virtually no risk. If you have less than the FDIC kind of insurance threshold, around $250,000, even if the financial institution goes under, which in these days is very, very rare, your money is protected. As you start inching up, you see that other types of investment choices carry a bit more risk. Bonds have a little bit of a risk because the government or the company could default on the bond. And this has definitely happened, both companies and governments as well. The US has not defaulted, but if you think about other countries, especially in emerging markets who are a bit more precarious, they have in some cases defaulted on their bonds. And even within bonds, there's a whole spectrum of risk. There are companies out there that rate bonds based on the level of risk. And so you have bonds that are very low risk, and based on different ratings, you have bonds that carry much higher risk. Then you have things like mutual funds and stocks, at least on this spectrum, I put as having higher risk. And I'll talk about what I mean by risk. Are stocks the end of the spectrum? Absolutely not. I would put Bitcoin far to the right in terms of risk of stocks. And you could think of things like real estate or commodities like gold and oil. All of those are even probably riskier than stocks. The reason I don't even put them on here is I don't really want to distract people by thinking of those. If you ask me, Bitcoin or crypto as an investment choice, probably something that pretty much everybody on this call, including myself, should be steering clear of. Now, the reason I talk about these different investment choices and level of risk is that when it comes to how much risk you take on, it's not a one-time decision. The longer your time horizon until you need the money, the more risk you can afford to take on. And so one of the other really important questions to think about when you're investing is, what am I investing for? In other words, am I investing for something that is going to be in the short term? Let's say you want to buy a house in a year, and I would put that as a very short-term time horizon. Given that short-term time horizon is going to have should have a very big implication on the type and the amount of risk that you should take. And generally, the shorter your time horizon, the less risk you want to take, and the more you should start steering towards things that are in the middle or kind of towards the left. On the other hand, if you're investing for something that's 20, 30, 40 years down the road, let's say retirement savings, or let's say you just had a baby and you want to put money away for their college, and let's say that's in 18 or 19 years, you have a much longer time horizon. And at least for now, you can afford to take on a bit more risk by investing in riskier things like mutual funds or stocks. So whenever you're thinking about investing, it's really important to say, what am I investing for? And based on that time horizon, how much risk am I willing to take on? Let me show you why this matters and why you need to think about risk and time horizon so closely together. If you go back to that 1914, 2014 timeframe, let's say you had invested $1,000 in stocks. If you were to look back over that 100-year time frame, what's the kind of maximum amount that you could have made in a given year? Let's say from 1920 to 1921, 1972 to 1973, et cetera. In the best year, you could be up $53. You could have made $530 bucks. However, in the worst year between that time frame, you could be down about 27%. You would have lost $270. Think about it. If you're saving for a home purchase in a year and you're saving for a down payment, and at the end of the year, you only have about 75% of the money you had, you may need to adjust the type of house or apartment that you're looking for because your money is worth a lot less. Now, let's take a 25-year time horizon, much longer. Let's say you invested $1,000 in stocks and you took all the 25-year time horizons between early 1900 and kind of the mid 2000s. In the best 25-year time frame, you would be up about 11% annually on average. In the worst 25-year time frame, you'd be up 8% on average. That's not so bad. If you're investing for the long run and you say either I'm going to make 8% on average a year or 11%, probably a little bit more comfortable with that range. So that's just an example, and I'll depict it here in terms of showing kind of the annual returns on stocks as you're looking over longer time horizons. So I'll point to two things here. One, look at the range and how the range essentially starts to kind of minimize. Here, you're looking at a range of about 78%, right? You're going from negative 26 to 52, 53%. That's a pretty wide variance. Notice how as you move from different time horizon periods, from 1 year to 5 year, the range starts to shrink. Now you're looking at a 25, 26-year time range with 5 years out. And ultimately here, you're looking at a 3% range in returns. Number two, look how at the bottom, which is like the worst you could do. As we talked about, on a 1 year time frame, you could lose a lot of money. Over a 5 year time frame, you could still lose a little bit. But when you start getting to 10, 15, 20-year time horizons, the worst you could do is still a little, kind of is pretty good. Now, is 1% as good as 8%? Not quite, but at least it's positive, and you can see kind of the returns there. So let me cover a little bit here, and I'll get to a question that was asked. Just to give this, put this an example for last year. Last year was a roller coaster ride. January 1st, 2020, Dow or the S&P was at about 3,200, rose about 4% by mid-February. Things were looking pretty good. But then, as all of us know, COVID hit. Look what happened. Between February and kind of mid-March, drop of about close to 50% in the market. And even in April, the market was down about 15% from where it was at the start of the year. Now, by the end of the year, the market was actually up 13% by itself. And so if you had a really short time horizon, let's say you had an emergency fund that you had, and let's say you had invested it, and let's say you lost your job and you needed it between March and April. If you had invested it in stocks, you would be having to take a really, really big loss. If you had a much longer time horizon, you would actually be up a fair amount. So we'll keep that there just as an example. There was a question that came in about how do you account for cyclical busts? It seems like every 4 to 5 years, there's a correction in the stock market or a recession or a bubble bursting. My response to that is it's really, really hard to account for those. And the reason I say that is because of this slide, which is when you try to time the market, you end up missing out a lot of times on really important days in the market. So what you see in this example is essentially annual performance between 2000 and 2019. If you had been invested, from day one until the end of this time frame, you would be making about 6% a year. Or if you had invested $10,000, you would have about $32,000. And it shows you what happens if you start missing the 10 best days or 20, 30, 40, 50, 60 best days. You see that very quickly when you miss out on the best days, your returns go negative and a $10,000 investment starts to go under. Now, why do I mention this? Because it's really hard to know, obviously, which are going to be the best and the worst days. And oftentimes, as you see here, the best days in the market follow the worst days. And so my answer in terms of how do you account for cyclical busts is if you're investing for the long term, you want to mostly ignore them. If you're putting money away pretty consistently and saving for something that's 20 years down the road, cyclical busts and any sort of up and downs in the market will just be absorbed out over time. Now, there may be opportunities where you say, if there's a bust, I have money on the side, maybe I want to start investing a little bit more. You can do that, but it's a little bit harder to kind of time it. And just use this as an example. If you look at kind of what happened in March, such a precipitous drop. But then if you look at the slope of the blue line, which is showing you the kind of daily or kind of weekly returns, you can see that some of the biggest returns came right after the sharpest drops, going into kind of April here or kind of this red line here. And so timing the market in terms of trying to say, oh, the market's dropped, maybe I should sell and buy later. If you were to kind of try to do that, you'd miss out on what arguably are some of the best days of the year, which happened in kind of late March, early April, when things started to stabilize a little bit. So if you're investing for the long run, my advice would be ignore as much as possible the boom and bust cycles. Keep your eye on the long-term prize, knowing that over time, any kind of time period, you've seen any of those kind of corrections account for themselves. Okay. So oftentimes people ask me, where should you open an account? We're not going to go into this into too much detail, but I will say a few of my favorite kind of firms to think about are Vanguard, Fidelity. I would also throw in, potentially a Charles Schwab or a BlackRock. I think these are great for a couple of reasons. These are large, very reputable companies. They have a lot of options and they have very low cost options. So going back to that Warren Buffett example, they have a lot of options that are very average, a lot of index funds and a lot of ones that have very, very low fees, which I think are phenomenal. There is a category of kind of companies called Robo Advisors, which are essentially a hybrid between doing it yourself and using a human financial advisor. I think companies or robo advisors like Betterment or Wealthfront, and Vanguard offers a robo advisor option, are very helpful for people who don't want to spend a lot of time or mental thought about thinking about investing, and they want something that they can kind of set and forget and have it taken care of at a relatively low fee. Betterment and Wealthfront all use kind of average funds as well. Betterment uses pretty much exclusively Vanguard funds, and so you're not paying a lot as well. The one on here that I would highly recommend to avoid is Robinhood. Robinhood encourages you to invest in individual stocks or very fancy, complex instruments like derivatives and options. They've gamified their experience, and I think in many ways, they encourage you to gamble with your money. And I use that word very purposely as opposed to invest. You probably read about people who made a ton of money in Robinhood, but a lot have lost a lot of money. And I don't think that if you're thinking about kind of being average or trying to win in the long term, I don't think that it's necessarily a site that you want to use. So there are a lot of others kind of that fit in here. Can't give kind of specifics on too many of them. I do think that, depending on what you're trying to solve for, you're maybe trying to maximize returns. You may be trying to maximize money and only invest in certain types of funds. So for example, there's a pretty big trend right now around only investing in different types of, sustainable mutual funds or ones with social impact. A lot of times, like some of these bigger companies are starting to create funds that have that. Otherwise, there are a lot of other firms that have funds that are specifically devoted to, companies that have a, very good corporate social responsibility plan or something of that kind. My advice is if you're thinking about investing for the medium and the long term, I would heavily focus, if not exclusively focus, on mutual funds as opposed to individual stocks or maybe even individual bonds. Mutual funds are going to offer you automatic diversification. You don't need to really research individual companies. You don't need to pay for trades. And if you're investing in average ones, they have much lower costs. Individual stocks, you require more attention. You have to research the companies. You have to think about when to buy, when to sell. I think at the end of the day, you're better off by focusing on mutual funds. If you are inclined, take a small portion of money, and ideally money that you don't need for essentials, and maybe invest that in individual stocks. But think of that as play money. That is really gambling. And I think of it that way as opposed to kind of investing, which is, I think, really about building and sustainable long-term wealth. So if you are looking at mutual funds, if you've been convinced by me, I would say look for index funds, i.e. average ones. These are usually passive funds that you don't need to, kind of have individuals who are picking stocks. They tend to have much lower costs and a lot of times avoid any additional costs from other companies in the middle. Not so good are what I would call actively managed funds. These are ones where you have individuals who are actually picking stocks, doing a lot of trading. They tend to have higher costs, which are often called out in something called an expense ratio. So usually index funds have very low expense ratios. These are usually expressed as a percent or kind of what they call BIPs or basis points. 100 basis points equals 1%. An index fund can have an expense ratio as low as 4 basis points or 0.04%. Actively managed funds have expense ratios as high as 2 to 3%, orders of magnitude higher. So one of the arguments that comes up is, well, yes, active funds have higher fees, but they also return more money. I'm here to say that that is not true when you look at the research over time. So this is a study this I chronicled from the New York Times a couple of years ago. They basically started with 2,800 different mutual funds that performed in the top quartile in 2010. And they looked at which of those funds actually stayed in the top quartile in the years that followed. And you can see that only 2 of the 2,800 plus funds were actually steadily in the top quartile over the course of 5 years. And you can see some of the kind of conclusions at the bottom, which is each time finding the same core truth held, which is very few funds achieve consistent and persistent outperformance. And moreover, some of the funds that sometimes were the best performing funds one year end up being the worst performing funds in another year. One question that came up that I want to kind of address, a few people asked about the difference between exchange traded funds or ETFs and mutual funds. I view ETFs as very similar to mutual funds, especially they're low cost and really, really good. Some of the main differences, if you're looking for lower investment minimums, ETFs may be good because you can usually buy in at the price of one share. A lot of times mutual funds have higher minimums to invest, sometimes $1,000, sometimes $10,000. The downside of ETFs is that you can't really automate transactions. With mutual funds, it's very easy to automate, kind of putting money in every month or kind of more broadly. ETFs require a little bit more, hands-on kind of investment works. But overall, I view ETFs as very comparable to kind of mutual funds. They're very, very similar on a lot of dimensions. And I think just to expand on that, they both are less risky than investing in individual stocks and bonds, a lot of different options, and I think can come with very, very low fees. So again, I just want to kind of call out that before you're even thinking about general investing, you want to make sure that you are thinking of kind of savings for your money. I know we're nearing the end. I do want to cover one or two other kind of pieces here. If you are going to work with a human financial advisor, there's one word that I really want you to remember, and that word is fiduciary. You want any advisor that is giving you financial advice to be a fiduciary and to have a fiduciary duty to you. Fiduciary is a legal term, and it means basically that person has a duty of care, and they are required to put your interests above anything else, including their own. And you may say, this is common sense. Well, of course I want somebody who's going to put my interests above all. Not all advisors are like this. And so question number one, if you're thinking about working with a financial advisor, is asking them and making them put in writing that they are and are a fiduciary and will have a fiduciary duty to you. Some people ask, okay, what does a portfolio look like? This is an example of a portfolio that I put together for someone thinking about investing for the long term. It has 40% in US large company stocks, 20% in small company mutual funds, 25% in international mutual funds in developed and emerging markets, and 10% in other. But what I want to say to all of you is there is no right answer. These are all pretty well-known websites, books, or kind of authors, and all have very different allocations for how they would create a portfolio. Some range from 3 different investment choices to 7, 8, 9, and more. There is no right answer. For me, it's really about kind of the basic principles, which are how do you think about putting in low-cost options, making sure that the choices and the risk level that you're taking on is matched up with your time horizon. And let me give you an example of that. This is an example of Betterment's interface, one of the Robo Advisors. Not recommending it, it's just happened to use this one. When you go in, for one of the first things you'll want to do is select the goal type, which is essentially asking, what is your time horizon? Is it a major purchase, safety net or emergency fund, retirement, etc.? And then depending on the target amount in the years or the time horizon, they'll recommend a portfolio for you. So you can see here that let's say you have an emergency fund as a goal with a 2-year time horizon. They may recommend, here they're a bit more aggressive, but they may recommend, some allotment of stocks and the rest actually being in, kind of a cash account. But look at here, if you're going for, let's say, a major purchase, let's say a down payment on a house in 5 years, they'll recommend a portfolio that's suited for that time horizon of 5 years. In this case, an almost 50-50 split between stock-based mutual funds and bond-based mutual funds. And then you see these words auto adjust. And what that means is that as you get closer to that 5-year target date, they're going to start de-risking your portfolio and start putting in less money in stocks and more money in bonds. And this is an example of that. Basically, obviously your time horizon is going to change as you move closer to goals. And so one of the things that either you need to do or a robo or a human advisor will need to do is change the allocation of your portfolio as you're getting closer to that time horizon. This is an illustrative example of investing for retirement. When you're pretty far from retirement, you can have a portfolio that's heavily skewed towards stock-based mutual funds or ETFs. As you get closer to retirement, you're going to want to take less risk because you need the money sooner. And therefore, you should be shifting into safer assets or shifting more into bonds. So that principle of your overall portfolio allocation is not going to be static. It's going to shift over time. It's something really, really important. And it's something that you can do yourself. Or if that kind of makes you anxious, you can work with a robo advisor or a human advisor to kind of do that. I'm going to purposely kind of pause here to leave time for some questions. I did leave up some suggested resources. These are some books or websites, blogs that, depending on your best means of consumption, I think are pretty good to help you learn a bit more. Also, if you are looking for a fiduciary advisor, I gave 2 different sources that I think are really helpful. The XY Planning Network, or NAPFA, which is the National Association of Personal Financial Advisors. They essentially screen and they only allow individuals or advisors who are fiduciaries to kind of be within their network or their association. So if you are looking for someone and want to make sure that they have your best interests at heart, those are kind of two good places that you could start. Let me turn over to Migdalia just to see if there are some questions that we can cover in the last 5-7 minutes.
Thank you so much, Shahar. We're getting a lot of great comments regarding all the great information that you shared. The first question that is, what is the risk with CDs?
Yeah, it's a great question. With CDs, you're putting your money in and you're essentially locking it in with a financial institution for 3 months, 6 months, 12, 18 months. The risk with CDs, it's not very large, right? One is if you lock up your money for a long amount of time and interest rates spike, you potentially can't pull that money out and invest it at a higher, in a higher interest bearing account. You're also locking your money away. So let's say you put money away in a 12-month CD and all of a sudden you need the money. You may have to pay a penalty or kind of forego some of the interest in order to redeem it right away. But in terms of the principal and the amount that you put in, there's very low risk, if any, in terms of the money that you're putting into a CD.
Thank you, Shahar. And there's a little bit of feedback. Shahar, if you don't mind maybe lowering the volume, I think, on your end.
Yeah, let me do that.
Thank you. Okay. Yeah, I don't hear it anymore. So someone asked if we have any thoughts on investing through our own bank. In their example, they mentioned Citi or Bank of America.
Yeah, look, I don't know the specifics with those two. I will say, what I found, and this is a very big generalization, is that oftentimes going through banks, you're sometimes steered towards actively managed funds, or the expense ratios and the expenses tend to be a bit higher. That's a very big generalization. So it would really require a little bit of research to look at what are the funds that Citi, Bank of America, and others are offering. What are the expense ratios of those funds, and how do they compare to what I would say are the larger investment management firms? There may be, and there probably are some that have very low cost average funds, in which case, great. But I found and looked at a couple that sometimes they tend to steer you towards more actively managed funds that have higher fees. So I can't comment on any specific one, but that's been kind of my general view so far.
Thank you. And someone asked, how do we know if a mutual fund is index or actively managed?
Yeah, it's a great question. Oftentimes when you look at a specific mutual fund, you'll be able to actually download essentially a lot of information about it. It has like a one-page fact sheet or not. Usually those will state what type of kind of fund it is. The other way is honestly looking at just the expense ratio. Most actively managed funds have expense ratios that are, let's say, 0.5% or up to 2-3%. I haven't seen many, if any, index funds that have expense ratios that broach even 1%. So you should be able to go in and look. And frankly, if you have questions, and let's say you're on Vanguard and you're looking at their funds, you can call into their customer service or use their chat and basically ask about specific funds. And you can ask, like, is this an index fund? Is this actively managed, et cetera? So you have a couple of different ways, but asking is not a bad option.
Thank you, Shahar. We have a lot of questions that are coming in. So I just want to remind folks, we are not going to be able to get to all questions. Someone did ask specifically about your PowerPoint and if the chart with all the resources. We are going to email you all by Monday a copy of the slides, recording, so you'll have that information. Another question that came in is if someone is looking to buy a home and they're looking to do some home renovation in the low 6-figure range in the next 12 months, they have most of their money in savings account, but is there a better way to store that money for a short period of time?
Yeah, I mean, look, I think a savings account, if you're going to do it in 12 months, is probably the right place. If it's in 12 months, you could maybe put it into a CD and earn a slightly higher interest rate. And then if you're comfortable taking a little bit of risk, you can put a portion of that into, bonds or kind of a stock-based mutual fund. But you have to be, kind of going with the understanding that there's a likelihood that the market is going to decline a little bit or significantly in the next 12 months. And so you should only put money away that you'd be comfortable continue with that renovation without. But in general, if you're looking at 12 months, I would recommend the savings account, or if you want a little bit more, thinking of a CD or a money market account.
Thank you, Shahar. And I also want to put a quick reminder that we do have a survey. We have a lot of folks that are putting in comments saying that Shahar's presentation has been helpful. Thank you for letting us know. Please let us know in the survey. We won't have access to the Q&A afterwards, so the survey is really the best place to let us know. And for our last question is, do you have any suggestions on finding funds with social impact that are reputable?
That's one I'll probably have to come back with. It's something I've been starting to look at. I haven't gone too deep on that research yet, so I don't necessarily have anything that I'm comfortable recommending. What I will say is I have seen at least some of the bigger, more reputable firms start to kind of offer these. And so I would start by looking at the company that's offering it. And if that's reputable, then I think in many ways, you should feel better about the funds themselves. But I have to unfortunately punt on the specific funds just because there aren't ones that I'm yet comfortable to recommend.
Thank you, Shahar. And that's one of the many things that we appreciate is the honesty and everything that you share with us. And thank you so much for today's session. Everyone, thank you so much for joining. A quick reminder, tomorrow we have a student loan repayment session that starts at 5 p.m. So a common question that we'll get is, well, how do I invest if I still have student loans? So, now you know the importance of investing. Come to the student loan repayment session tomorrow at 5, the same link. You will receive a recording with today's presentation and all the other presentations. We also had questions about savings accounts and where to put money. Our Chief Financial Officer and branch manager will be with us on Friday at 1 p.m. Join us then, ask them questions directly. And thank you again. And I have nothing else but many, many more thanks to send to you, Shahar, and for everyone for joining. And we hope you have a wonderful afternoon.